The
Yep.
simple one is just save money in your whole life, money in
Yep.
cash flow, a certain amount to eventually borrow, to eventually pay off higher interest debt than what
Or-
your loan interest rate would be in the policy. About as simple as that. And then the cash flow that you recover, you start to pay back that loan. So you're reducing the interest cost even further on it. What's your thought on just
uh,
that? Simple, straightforward,
I love this. So I think this is one of another overly sold
overly
processes
sold.
online.
Okay.
And it's not that I don't like it. There are instances, like, again, it's always compared to what? That's what we always have to be thinking.
Yeah.
There are instances where I think utilizing whole life insurance to pay off debt is wildly amazing, right? Like, but it always depends on what type of debt it is, where the debt is, what your cash flow is like, how much liquid capital you have in different accounts. I'm a big fan of refinancing debt into a policy, right? So when we refinance the debt into a policy, that looks like something like this. If I got $50,000 of credit card debt or consumer debt, what I would call consumptive debt, right? Like, I look at debt in two ways: productive and consumptive. Like, it's either increasing your capacity to create wealth because you're utilizing debt as leverage, and debt always comes with risk when we're doing it for that. But your productive debt, you're looking to utilize debt for creating wealth, and consumption debt is more lifestyle debt. Like, this is the consumption debt would be financing a car, would be going on vacations, would be, slapping a vacation on a credit card. Like, that's consumption debt, like that kind of stuff.
Yeah.
Um, productive
Somewhat
debt,
constructive.
creative debt is saying, hey, I'm going to take a loan on an investment property, like whatever, and that's like, all right, it is what it is. You got an asset behind it, you've got cash flow behind it, like all these different things, and you got to learn how to manage it all. But like, getting back to the point is, if you got $50,000 of credit card debt and maybe high interest debt, like a personal loan or something like that, in the 10, 12, 15, 18, 20% range, which happens, it's shockingly all the time. It's like, the challenge is, if I'm saving in a whole life policy, like, and this is the challenge, and I looked at this the other day, where somebody was like, I'm going to take your 30 years it's going to take you to pay off your debt. And they include the mortgage, they include all this stuff. And they're like, we're going to pay it off in 11 years. And it's like, I looked at it and I'm talking to this guy and he's trying to sell me, right, that this is the way it works. And I'm like, is it though? Because when you get to the 11 years, you still have debt. The debt is just in the policy loan, right?
They
And
forget
so, are
that.
you really debt free? Are you really debt free? And so, and it's used, once again, it's used as this marketing tactic, right? Now, I'm not saying it's bad, right? Like, I'm not saying this situation wasn't bad, but or was bad. It could still be a positive outcome from a
Yeah.
math perspective, from a long-term perspective, right?
Mhm.
And it may have still been in alignment with what they were trying to do from a long-term perspective and more efficient than what they were currently doing. My problem comes in, like, tell the whole story. Don't market this as if they're going to be debt free at year 11, because they're not. They've just simply refinanced their debt into their policy. And if they don't really understand that and wrap what their expectations of themselves are, and the human behavior and the consumer behavior and the investor behavior and savings behavior and all these different things, well, then they're going to get to year 11 and their whole financial life is going to be jacked up because their expectations are out of alignment. You know what I mean? And so that's my problem with this kind of stuff. Now, so I am also, I'll say this, like, if you got 20% interest debt, like, the thing that I don't like is when people say, all right, you're paying $1,000 a month, so let's just take that 1,000 a month and flow it through the whole life policy and then pay off, take a loan from the policy every month to pay off the debt.
Hold on, we're gonna get there. We're gonna get there.
Okay. All right.
Because
All right.
I got that on the next
You
one
got
here.
that. So like, then we'll go there then in a minute. What I will
Yeah.
say that I do like, I'll talk about what I do like then,
Okay.
is when, if you have a bunch of debt and then you have a bunch of savings or investments, I'm a big believer in changing human behavior and utilizing these assets that you have to increase your financial efficiency, putting that money into a policy, borrowing against that policy, refinancing the high interest debt into a lower interest debt environment. But let's be real, you do this probably more than I do as far as dealing with these sorts of situations due to the nature of your content, your channel, and how you serve people. Most people that got $50,000 in credit card debt aren't sitting on a pile of money somewhere else. Like they got
No,
different challenges, right?
correct. So the and I'll close out saying that there's, again, you're not totally against the idea of funding a policy, borrowing against it eventually to pay off some non-productive debt that's costing you a
Right.
lot of cash flow, and you refinance in the policy over a long period of time, you end up paying far less in interest
Yeah.
costs. Um, but you can still, they're still looking at the full entire picture of like, okay, yeah, now that the debt's gone, but also run the math on how long is it going to take to actually pay off the loan. And
For sure.
oftentimes that math gets taken out of context. It gets
Yeah.
just forgotten about. And then you
Yep.
also have to keep in mind that you're still funding the policy. You still need to fund that policy. What are we doing with the extra cash flow? So
Yep.
there's where I've worked with clients on this in that case is when we've already established a pretty good foundation, because majority
Yeah.
of people I work with have no foundation, have no life insurance, no whole life, tons of debt, six-figure plus debt, and we're using other debt elimination methods that don't involve a whole nother product like whole life out the gate.
Yeah.
And once they've really built some strong positive cash flow, 1,000, 1,500 or more, then we start to look at, okay, what would it look like to start saving money while still getting out of debt and running the full
Yep.
math on it. So yeah, my practice has, I've been that guy that just told one part of the story simply because
Yep.
I was told one part of the story and it made perfect sense. And then over
Yep.
the years, it was like, wait, there's more to the story. And it's
Totally.
actually really exciting when you get the client to see the full story at hand. So,
And isn't that the part though, Denzel? Isn't that the cool part? Is like people are telling half the story to try to make it hyped into something that it's not, and they're creating confusion and they're misleading people. Whereas if you actually empowered people with the whole story and let people actually take accountability for the whole situation, they're going to be more excited because what we do
yeah,
and the power of it is so powerful and so impactful. Like it's just it's some of this stuff like with the cars and the debt, like which are the two most common areas where people are misrepresenting how this works. If you would just tell the truth, it's better than what you're selling, but it's like you don't have confidence in yourself to have the whole story.
I
I
agree.
think that's
I was that guy. Early on in my YouTube years, like I definitely what like if
yeah,
you go back, you see case studies, like I mapped this stuff out. It looked amazing, and I mean, it was like people
yeah,
did get results in a sense, but I also didn't
yeah,
know the rest of the story that was at
right,
play. Where
yeah,
now I'm still doing, sometimes some cases involve paying off debt using a policy, but
uh-huh,
I'm also telling the full story where I'm like, hey,
perfect,
we're in a unique position here where we have options. That's kind of how I present it now with the client, where I'm like, hey, we could totally use this policy, pay off debt, and we'll save money on interest, and we'll cash flow, and we'll make some net positive arbitrage, and we could show the math for that.
yeah,
But you're also in a position where you've got almost six figures in this policy built.
mhm,
What if we started increasing your knowledge on your investor DNA? And let's figure out a little bit more about who you are as an individual and how you can create more value in the marketplace and use your
that's
whole
what's up.
life as a hedge. What's the
That's it.
math behind? And so
That's it.
sometimes the client will say, "I'm not ready, Denzel.
Right.
I'm too scared. I'm not ready yet." At
But
least
that's
I at least I heard that, you know.
But that's the key though. What you just said there is you're not now pushing your agenda to get them to do something. You're being a financial guide that's helping walk them down a path for their own journey of self-awareness, and you're trying to help them create alignment in their life, right? So they can be a better consumer, a better investor, you know, a more educated individual when it comes to personal finances. Like
Yes,
and that's the empowerment. You're empowering them through creating alignment through this education. And that's the key. None of this is good or bad. Is it aligned or is it misaligned
yeah,
with what I'm trying to do? And
absolutely,
that's the key.
I love it. So the next one here, which you were diving into, I'm actually going to skip over this one, the third one. We're going to the
Okay.
fourth one. And this
Okay.
is saving your money in a whole
Yeah.
life, the cash flow you
Yeah.
have, plus the debt payment that you have on a debt. Let's say you're cash flowing $1,000 and you
Mm-hmm.
have $750 of debt payments. So what you're
Mm-hmm.
actually going to do is you're going to fund a whole life contributing the whole 1750, and then literally within 30 days or less possibly, you're immediately taking a loan out for 750 and maybe a little bit more from that initial 1,000 of your cash flow, and
Sure.
you're gonna pay down your debt over time. So you're gonna pay your debt payments plus extra goes to principal, and this is the bank on yourself community
Yeah.
that preaches this a lot. And
Yeah.
I've personally seen people self-destruct with this
The worst.
because you are slowly creating a large group of loans in one
Mm-hmm.
policy, and depending on the type of debt that you have and the speed at which it gets paid off,
Uh-huh.
there you could absolutely show on paper, for sure. You can absolutely show on paper that it'll work. Here's the problem though. What if the dividends in the whole life don't perform as well as the illustration, or it goes down? Or what if life happens to the client?
Yeah.
Just life. And here's
Yeah.
the
Yeah.
other thing is you're creating like multiple manual steps for the client where they have
Yeah.
to intentionally set up auto pay of the 1,000, plus they have to strategically get the 750 in there. And let's say that 750 is 3 4 debts. They have to strategically make payments into their policy before the due date and then request the loan before the due date to avoid
Yeah.
late fees. And so you were about to, pop off on those that do this in a sense. So what's your take on the community that's preaching this, and
Well,
is there
it
room
all comes
for
down.
is there room for improvement? Is there a way to frame the conversation differently, not to bash these people, because I do believe they have good intentions, and I sat through in a presentation, I'm like, this would convince any one of my clients that don't have the level of financial literacy and the capacity to think about the whole picture. And so I can see why even I myself would buy into this. And but if you dig, deeper into it,
Yeah.
you're it's like you're trying to build a farm or lay seed out with the smallest tools in the shed instead of the biggest, most efficient tool to lay out
Yeah.
the soil and to
Well,
plant the seed. It's like you're using your bare hands, let's just say, to
well,
try to make this happen instead of
yeah.
using
Well,
the proper tools.
totally. The argument for the people that believe in this concept is the fact that, like, all right, if I got the 1750, I'm going to borrow. Let's call it 1250. I'm going to borrow every month, right?
Yeah.
Against it, and I'm going to pay debt down. The problem is if we go do the 1250 versus the 1750, because let's make no mistake about it, like what most of the people are doing are saying, well, right now you're paying 750 down towards your debt, and you got this extra 1,000 that you're saving. So let's take the 1750, put it in the policy, borrow 1250 against it, and now you're paying that 1250 down. It's going to make the debt pay down look better because you got an extra $500 a month going towards the debt pay down. But that you're not comparing. Remember, it's always compared to what? You're not comparing the cash flow properly. Because if you were to, what you really need to do is look at what would it look like to pay down your debt at 1750 a month and
Like
do all
just
that, because
straight.
you got just straight, right? Because there's that extra $500 that you're putting in the policy that listen, this is a long-term strategy. There is a cost of insurance, there are admin fees, there are all these things, and from a long-term perspective, it's amazing. And the one of the biggest risks that you have in these policies is getting the policies, taking loans immediately or virtually immediately. And when I say immediately, I basically mean first year, second year, or in that range,
Yeah.
and not having a plan to pay those loans back anytime soon, right?
Correct. Correct.
And that's where these things blow up all the time. That's where infinite banking, bank on yourself, whatever, falls apart. That's the only way it doesn't work. Okay. Like, quite frankly, is when you start borrowing against these things virtually immediately and not having a plan to pay the loans back or to manage the interest expense on those loans. And I know everybody likes to say whole life insurance has simple interest, life insurance has simple interest, but that simple interest is annual and that does compound over time if you don't pay it back. And that can cause tons of problems. So what we have to do is go back to what I was saying before: opportunity cost, cost of capital, and time value of money. So when we look at this, it's like, if you have 18.99% credit card interest, right, which is a pretty common number for a lot of people, if that's what you have to look at the opportunity cost instead of that 1750, the paying the 1250. What's the opportunity cost on that $500 a month at 18.99%, right? And you know, it's just a matter of doing the math. You know what I mean? But once again, people will go back to this and be like, "Oh, your credit card debt is paid off so fast. Look how amazing this is," but they ignore the loan balance sitting in the policy, right? And so when you do that, I think it's important when you, if you are a consumer that's looking at doing this, make sure that the math checks out after looking at the loan balance inside of the policy. When they tell you you're debt free, check in and say, all right, what's the calculated loan balance inside of the policy? And you can run illustrations with the loans pulled out, showing you what it looks like with today's current assumptions of where the dividends are and so on and so forth, which I think, with dividend rates being as low as they are, I think is pretty safe to do at this point in time. But you know, you still have to do that. And so I'm not a fan typically of that in this. So my philosophy in this instance would be: buy your net worth, build your cash flow. I'm really big. Life insurance is what we do, right? So like life insurance first, buy your potential net worth, get a term policy that's convertible, lock in your ability to do this long term, spend 30, 40, 50 bucks a month on a couple $1 million term policy if you're 35 or so, something like that. And then, and obviously you got to look if you're older. Like, I just bought a $2 million term policy last year at 44 years old. It cost me like $1,600 a year. Like, so do that, you know, do that and have it be convertible, but then take the extra cash flow you do out of that 1750 and just jam it towards paying that debt down. Once the debt's paid down, now start converting the insurance that you have to a banking style policy, the banking alternative policy. That's kind of the way I would handle it.
Yeah. Thank you.